Greetings from FinStudy Club. My name is Ankur Kulsresht, welcoming all viewers to the series of videos that we are recording for a very important module called Ethics and Professional Standards. Now, I hope that the viewers have already looked at the previous videos of the same series, wherein we have already created a good overview of the codes and the standards. Then we have already done what do you mean by codes of ethics and how they form the basis of different aspects covered in different standards. And then coming to the standards, we've already done standard number 1, which is professionalism. So this brings you into a very interesting standard related to the integrity of the capital markets. Now this is going to be a very short video, maybe 5 minutes. The standard broadly covers two small parts. One is the use of the material non-public information, and the second is the aspects related to the market manipulation. So let's just look at these things in detail. Now, as far as the first substandard is concerned, the use of the material non-public information, I would like to draw your attention to the different characteristic which is mentioned here. One is the materiality aspect, and the second is the non-public aspect of it. What this substandard talks about is the fact that if any member or a candidate gets in touch with or possesses or gets access to any information which is material and at the same time it is non-public. Let's just understand what you mean by material. Now, any information is called as material if it's got the power to change the decision of the decision maker. In other way, we can also define it as the information which has the power to change the price, the market price, I'm saying. Any information is non-public, or if it is disseminated to a select group of audience which is not available to the public at large. So that's pretty much self-explanatory. So this particular standard talks about that members in the candidate who possesses such an information should not use it for their decision making, nor do they pass on this information, nor do they should assist someone else who has access to this information. Well, again, the idea is that at large, the investor community or the capital market, the informational efficiency is one of the things that you have to look out for. Now, obviously, by superior intelligence or by doing an extra research or by going extra mile, if someone is able to draw out conclusions based on his intelligence, then obviously this point doesn't come into application. But yeah, overall, if let's say an analyst overhears two CEOs talking in the golf course, while playing golf, an analyst who also was there to play golf just overhear two CEO talking about a particular potential joint venture. Now this kind of an information is obviously very material and hasn't been disseminated to the public. So that analyst who got this information should not use this information until and unless the information is being disseminated to everyone at large. So what does this guy is supposed to do? He is supposed to request the CEOs, or should I say ensure that the information is made public ASAP so that he can make a use of that. Okay, let's just read on the slide. It talks about that the candidate who possesses material non-public info that affects the value of the investment must not act himself or cause others to act. Okay, the indirect reference that we were talking about. And then the second bullet talks about the definition of what is material and what is non-public. So explaining this point again a bit more, it says that the selective dissemination of information to a smaller group of analysts is an area of potential conflict. What I'm trying to say is, let's say a company, name any company, let's say GE. Now GE holds an analyst conference. Now an analyst conference is attended only by 20 people. This is not supposed to be called as public at large. So such an information which GE has given to all the analysts should be requested to be made public as soon as possible, and only then it should be used therein. Now what this particular theory talks about is very important from an exam standpoint. The conclusion so far that we have drawn together is that by using, let me draw this thing for you, the means and the end. The means is material and non-public information if, let's say, leads me to a particular analysis, and I'm naming that analysis as X. Maybe X is that we should issue a sell rating to G. Maybe this is the end result that the information that I get access to will lead me to. This standard clearly, prohibits use of such a information, and therefore prohibits the analyst to, issue a sell rating based upon this information. But what if another analyst called B, by using information which is either non-material or information which is non-public or both, by his superior intelligence and analysis, is also reaching out to the same conclusion and is actually issuing a sell report on GE. The question is, would analyst B also be prohibited under this substandard? My mosaic theory says no. There is no violation when an analyst reaches the same conclusion, but by using an information which is either non-public or non-material. So I can summarize this standard by saying that it is not the end that matters, it is the means through which you arrive at that particular aspect is what is crucial. Okay, so that's your material non-public information, which standard is